Yunji, NASDAQ ticker YJ, just posted a brutal double miss for Q2. I mean, EPS came in at negative $1.18 against a negative 31-cent consensus.
Oh, true, yeah.
Right. And quarterly mapped revenue barely scraped past $7 million, completely missing the 16.8 million estimates. Zooming out, total H1 2026 revenue collapsed nearly 40% year over year to 96 million RMB.
And making matters worse, management went completely dark on quantitative forward guidance.
Yeah.
Like zero visibility.
Yeah, markets absolutely hate that.
Exactly. And the stock reacted violently. Pre-market shares tanked over 9%, followed by, extreme low float intraday volatility. Trading volume spiked, almost 4,000 times its daily average before closing down over 6% at $3.98.
Okay, wait. A 40% top-line collapse is massive, but was this violent market reaction driven more by that revenue cratering or, the fact that management gave zero forward guidance? Because
Yeah.
absolute silence is basically flying blind.
Well, it's definitely the combination. But if you look at their actual strategy, that revenue drop isn't just a symptom of soft Chinese consumer spending. It's actually by design.
Wait, really? By design?
Yeah, Yunji deliberately purged lower quality third-party merchants from their platform. They want to focus almost entirely on premium self-operated inventory.
Oh, I see. So it's kind of like pruning a tree. You sacrifice the sheer top-line size to force resources into the highest yielding, most profitable branches.
That is a great way to put it. Pruning a tree to protect the bottom line. And we know it's working because their gross margins held completely steady at 41%.
Right, because they aren't paying for all that dead weight anymore.
Exactly. Operating expenses were aggressively slashed by almost 39%. That actually narrowed their H1 net loss by 28% to around 72 million RMB.
Wow, so they're actively shrinking their footprint to get closer to profitability.
Yes, self-operated merchandise is now 70% of their sales. And those higher-margin private label products, they make up 56%.
And looking at management's commentary, they're leaning hard into this, what they call the organic living and food medicine homology niche.
Right, like their Polygon MT.
Yeah, exactly. But what really stands out to me here are their traceability events.
Oh, those are fascinating. Like the Bayou Shan Birch Sap event.
Right, they physically took buyers to see the origin of the sap, and it boosted sales for that specific product by 128%. It's a highly effective mechanic for building trust.
Definitely. When you prove the premium nature of a product firsthand, it locks in customer loyalty, which explains why their repeat purchase rate is sitting at an incredibly strong 69%.
Those repeat purchases are phenomenal. But I mean, to see if Yunji can actually survive long enough to enjoy that loyalty, we have to look at their balance sheet today. Because there are some immediate red flags for me.
There absolutely are. Despite the narrower net loss, operational risks are elevating quickly. For one, their short-term borrowings tripled to over 120 million RMB.
Yeah, and why would a company still sitting on over 240 million RMB in liquidity suddenly need to triple its short-term debt?
It points directly to cash flow timing issues.
Oh, because of the inventory.
Exactly. When you pivot to a self-operated private label model, you have to pay for manufacturing and hold inventory up front. You're not just taking a cut as a middleman anymore.
Right, so that burns cash significantly faster.
Much faster. Add to that, they took a nearly 20 million RMB impairment hit on property and equipment.
So they are basically admitting on paper that the physical infrastructure they bought for their old, larger business model is now, well, practically worthless for this new streamlined approach.
Precisely. Which leaves you with the ultimate puzzle for this stock.
Right, the final question.
Exactly. If you're looking at these numbers, you have to ask yourself, with a 69% repeat purchase rate, if Yunji successfully shrinks into a highly loyal, high-margin organic health niche, does that make them a prime, undervalued acquisition target for a larger player? Or are they simply a shrinking fish in a tightening consumer market?
A highly profitable niche target or just a shrinking fish? That is definitely something for you to mull over. Make sure to follow the show for your daily earnings coverage, and we'll catch you on the next deep dive.